Good afternoon, everyone. Welcome to Debt Management and Issuers and an Investor's Point of View. My name is Don Maruska, and I serve as Director of the CSMFO Coaching Program and as moderator for these webinars. Today is August 20th, 2013, and we're delighted to have all of you in attendance today. This webinar and these programs come in the 15th year of these services as a member benefit, and the Career Development Committee volunteers throughout CSMFO work to help identify key topics and things that will be of value to you, the members, and we appreciate their guidance and their support and sponsorship of these efforts. So as an overview for today's session, I want to highlight that we're looking at, what's the impact of recent municipal bankruptcies and declarations of fiscal emergency on the ability to issue debt. So what's changing in the climate? What can you do in local agencies to position yourself more effectively with regard to the management and sale of your debt obligations? And how can you serve your agency's needs in these challenging times? What are the things that are critical to be doing and how to do that in the new investment environment that we're in? For that purpose, we were delighted to have an outstanding group of panelists. We have Sarah Oberlies-Brown, who's a Managing Director in Public Finance at Stifel and Nicholas, and she's going to be kicking off on this topic. The biographies for each of our presenters are available to you in the agenda packet, and you'll see that each of them has an outstanding background and a lot to offer to you in terms of their expertise and their breadth of experience. Next, we have Steve Malikian, who's the bond counsel at Jones Hall, and he'll be taking the vantage point of how do bond counsels look at this, what advice do they give to clients about managing disclosure, managing compliance, what's involved in that. And then Jennifer Johnston, who's a Vice President and Research Analyst at Franklin Templeton Investments, is going to talk with you about, well, how do the people who actually buy these bonds look at this whole set of issues? What's in their mind? How can you reach out to them to create a favorable climate for your bonds? And what is that dynamic like in today's environment? And what are some of the decisions that she and her colleagues are making about local government debt at this time? And what does that mean for you? And then Lisa Taitano, who's the debt administrator at the City of San Jose, is going to be sharing with you her perspectives from an agency point of view of how this comes together, how she actually manages the issues around disclosure and compliance, and what's critical to be doing that effectively. And we'll be having a variety of polling questions that will be coming along the way. In fact, we're going to go to our first polling question, which is that we do have information that you provided when you register, but we know many times there are groups and more people that join in. So we're interested in launching this first poll and getting a clear picture at your location. If you have more than one person, certainly respond with multiple responses to this question. But let us know who it is that we have present. And while that poll is open, and we'll leave the poll open for about a minute, so please do respond promptly. I do want to highlight that if you have questions, that we encourage questions, send them through the question function on the webinar. And also, if you're wondering where the PowerPoint is for today, it's at the location that we have for all of these webinars, which is csmfo.org/training/webinars, and then click on Live Audio and Archives, and you'll see the agenda packet for today's session. And actually that runs to 96 pages, so before you start printing things, you might want to figure out which parts of that you want. But it's so extensive because we've got today's presentation, and in addition, disclosure guidelines and links to national organizations about disclosure guidelines and compliance issues, as well as a number of articles that give you a succinct view of what are current developments in the bond markets and what you can look at in terms of key issues that might be affecting you. So let's just take a look. We're going to close the poll here and share the results. So overwhelmingly, we have local agency finance professionals, members of CSMFO, we trust. We have some folks from general management, some investment professionals, and a number of others that are looking to develop their understanding and expertise. And in fact, CSMFO has established this debt management as one of the areas of core expertise for all finance professionals in local government that are seeking to advance. And so we welcome all of you being here today. So let's proceed with the next step here. And for that, I want to turn this over to Sarah Brown. And Sarah, would you lead us forward? And I'll take you to your first slide.
Great. Thank you, Don. I wanted to
So
start
we need you to speak up a little bit more loudly. I guess more people have come on the line. It's a little harder to hear you, Sarah.
Okay. I wanted to start off by thanking the CSMFO organization for providing us this opportunity to speak with you. As you may or may not know, this is somewhat of a repeat of a panel that we presented at the CSMFO's annual conference back in February. And in reality, we actually submitted the panel idea for consideration at the 2013 conference almost exactly a year ago today. At the time, the cities of Stockton and San Bernardino had both fairly recently declared bankruptcy. And although those two cities are perhaps more similar to your city, county, or special district than the city of Detroit, Michigan, I believe the timeliness of this discussion is really heightened by that city's declaration of bankruptcy. While our focus is really on California, it is important to keep an eye on the situation in Detroit, first because more so than Stockton and San Bernardino, the Detroit bankruptcy is being played out in the popular press, and second because the situation there really highlights the vulnerability of municipal issuers to ambiguity in laws about unsecured obligations. The title of my section is The Market We Work in, General Fund Financings in a Bankruptcy World, but it might be better titled, Municipal Bankruptcies, Why Should You Care? Why you should care. The simple answer to an obviously incredibly complex set of circumstances is because how these bankruptcies are resolved, those being Stockton and San Bernardino and clearly Detroit, really could dramatically impact your government agency's borrowing costs and possibly even its ability to borrow in the capital markets. Don, can you go to the next slide? No. First off, I wanted to highlight something that you don't see in too many articles in the popular press, but I always think it's important to keep in mind, and I certainly keep that in mind in talking to people about municipal bonds who aren't familiar with that investment arena. And that is that out of close to 90,000 municipal entities in the country, only something like 239 have ever declared or have declared bankruptcy in the past 30 or so years. So relatively speaking, that's a pretty good success rate. In any event, here on this first slide, I would ask for a show of hands of who's recently participated in the issuance of general fund certificates of participation or lease revenue bonds, but I'm sitting in an office by myself, so I guess that's not going to be all that helpful. In any event, we'll call this the Bonds 101 lesson on COPs and lease revenues. Those types of offerings were specifically created to circumvent statutory limitations on debt issuance. Under the law, they are not considered debt due to an exception for leases. These financings are set up such that some asset of the government agency is leased back and forth between the government agency and a public financing authority or corporation established by that same government agency. And the lease payment that the government agency pays to the authority or corporation for the use and possession of the leased asset becomes the revenue that ends up paying debt service on the COPs or lease revenue bonds. It's fair to say that the credit markets perceive a difference among leased assets, whether it be a city hall or a police or sheriff's station. I mean, that's considered more essential to the function of the government than something such as a convention center, a parking structure, or a park. You know, even in a situation where that parking structure is generating revenue to the government, where some of the other assets might not. But the idea is that if for the assets that are considered essential to the function of the government, that if the government agency did not have sufficient funds to pay all of its obligations, it would prioritize those that are more essential to the function of the government. Don, could you move the slide? The concerns that the credit markets have with general fund appropriation, lease revenue bonds, or COPs emanate from the fact that they're really just another payment that the government agency can choose to or to not pay. Unlike general obligation bonds, the revenue available to pay the lease payments is not derived from a dedicated voter-approved tax or fee that can only be used to pay that specific obligation. And unlike a water revenue bond or a sewer revenue bond, there's no stated priority for paying debt service or the lease payment versus paying for the operations of the government or versus paying for capital improvements. Moreover, unlike general obligation bonds or water or sewer revenue bonds, there is no requirement to raise revenue to make the lease payments. And bankruptcy cannot be denied due to an agency's failure to pursue its revenue raising options. Thank you. In terms of credit market reactions, I think the rating agencies, by both their words and their actions, are signaling that they will be assigning an increased weakness to this form of government borrowing. Pre-recession, the standard was a one-notch differential between an issuer's general obligation rating and its lease appropriation rating. That's beginning to change, and I think we'll see more of that. In October or November of last year, Moody's released a special commentary where it stated that in that company's opinion, it would be reviewing appropriation lease ratings for possible downgrades, and in fact, many agencies were downgraded. The commentary went on to state that in the company's opinion, COPs and lease revenue bonds, because they compete with other funding priorities that government has, and it's specifically mentioning pensions, they're highly exposed to the general finances of the government agency. The result would be an increase in the notching between a city's general obligation rating and its general fund lease appropriation rating. Instead of the one-notch differential, most would have a two-notch differential if there was an essential asset pledged. That differential would increase to 4 or 5 notches if the asset was considered non-essential, like a parking structure or a convention center. Standard & Poor's has seemed a little more subtle in their approach, but I believe that Standard & Poor's is going to be releasing in the next few weeks or months, a new approach generally to general fund appropriation leases. That's something that I know I'm watching for my local agency clients, and it seems that they're putting more of an emphasis on the local economy and the general fund reserves, and I suspect in the process there will be an increase in the notching between Standard & Poor's GEO bond rating and that same entity's general fund lease appropriation rating.
Given these dynamics, Sarah, are you finding or advising your clients to shift the type of debt financing that they're using because of these differentials and the evolution of the market given current circumstances?
Well, for certainly it would be from a financial standpoint, you would prefer to sell general obligation bonds. I mean, pure interest rate reasons. That being said, there's a much more difficult process to undertake to sell general obligation bonds, and so for most issuers, for their general financing needs, it does not make sense to pursue that as an option. It's not politically palatable in most cases. So I think that for California's local government agencies, their hands are really tied. There's really not a lot of options, especially with the end of redevelopment. Right now, for your general the general capital needs of the typical local agency, it's a general fund financing or no financing at all.
Okay.
And the next slide. As an investment banker, I straddle the interests and concerns of both the government agency issuer and the bond buyer investor client. So I want to turn to that area and help you understand the connection between the macroeconomics and i.e. what's happening in the financial markets with the macroeconomics of an individual credit. When we did this presentation in February, and I'm showing in the slide the municipal market data or MMD index. That's our generic AAA municipal market scale. You can see that in February and continuing into May that interest rates for municipal issuers were very, very low, barely reaching 3% for a 30-year obligation. And up until May 1st, investors were funneling money into fixed income markets. The top graph shows the inflows into municipal bond funds over a period of time, and the bars going up are positive inflows. You can see all of that changing around a little bit in April, but really picking up in May and through the summer months. And that's about at the time when we repeatedly saw economic data that highlighted a recovering economy, and the Federal Reserve began to talk more specifically about a timeline for an end of quantitative easing. Pre-May, an investor had to go out 30 years and choose a non-rated bond issue to even get to a 5% return. But with the shift in interest rates over the past 2 or 3 months, the investment interest of investors have changed, and they no longer need to accept as much risk in order to get a 5% yield. they are choosing to go into investments that are more liquid, meaning that they can easily sell those investments if they should need to. For example, if bond redemptions from municipal bond funds pick up. Isn't it? Next slide, please. As I mentioned, in this environment, investors can be choosy. The more sophisticated institutional type investors that care about the liquidity are for the most part staying clear of general fund, COPs, and lease revenue bonds, at least until some of the ambiguity is resolved in where these unsecured debts rank versus the payment of pensions and other government services. For the less sophisticated investors, the mom and pop investors, the concern there is headline risk, as well as a preservation of principal. No, these investors may not care necessarily for the ability to sell the investment, but you also don't necessarily want to own a bond issued by an entity in financial stress, and certainly the broker that sold the bond issue to the mom and pop investor certainly doesn't want to admit he recommended that you buy it. But clearly the interest there is a preservation of capital, and we're seeing mom and pop type investors also gravitate towards more secure types of municipal bonds, such as the general obligation bonds and essential service revenue credits. So in the course of the last year, and certainly in the last several months, the market for COPs and lease revenue bonds has become more narrow. You're really looking at investors that are seeking relative value, meaning that they're seeking higher yield for the same rating category. On the final slide, Don, please. The final slide, I want to talk about a bifurcated market between government agencies that can issue COPs and lease revenue bonds with relative ease, and the government agencies that have more of a challenge. And while this is true that the large issuers, the large transactions that are more liquid and are issued by government agencies that are frequent participants in the market and therefore have a well-known name or location, have an easier time selling COPs and lease revenue bonds, I don't want to mislead anybody in saying that they're doing it without paying a premium. It is still the case that the premium for issuing a lease revenue bond and COP in terms of interest rates is growing, has grown over the last several months and years, and is likely to grow as issues are resolved with the bankruptcies, at least if it's the case that bondholders are not made whole. I think it's also here, and again, I don't want to spend too much time talking about what's happening in Michigan or with Detroit, but in California, I don't know of any cases where an issuer tried to bring a COP or a lease revenue bond to market and was not able by virtue of the bankruptcies in San Bernardino and Stockton. But it is the case that in Michigan, and with the situation there, other local government agencies that are 100, 200 miles away from Detroit and have a very different socioeconomic and financial makeup are not able to come to market, or they do, they're at interest rate spreads that are twice those that they would have paid just a couple months earlier. I believe one issuer finally did make it to the market last week, but it had a situation where the state was a backstop to it, but 3 or 4 others have tried and have failed. So I think that it is, while we're not seeing that kind of reaction here, it is something to note, and certainly as the issues in Stockton and San Bernardino are resolved, and to the extent that they are impactful to the bond owners and possibly to the bond insurers in those cases, we could see more of a reaction impacting the California local government agency issuer markets. Don, that's the end of my part.
Thank you very much, Sarah. Let's go to another polling question here. We always like to know how many people are attending at each location. We know how many agencies are connected with us, but we don't know how many are at the end. And we always encourage people to participate as groups, because this gives you an opportunity to share perspectives and add value to your organization as a team. While that's happening, let me just check up with you on a couple questions that came in. So do you have any kind of bottom line advice for local agencies about timing? In other words, if they have some flexibility on when they're going to go to market, should they hold off for some of these things to kind of settle out? Are there cross-cutting things with the way rates are moving that would argue against that? What sort of points of view or different perspectives are there about for local agencies in terms of the timing of their debt at this juncture, given these uncertainties?
That's a good question, and certainly one that I know a couple of my clients are asking themselves, and I'm discussing with them. On the one hand, interest rates are generally moving up gradually. There was a big move in May and June, and since then the day-to-day movement has not been as dramatic, but the trend is still towards higher rates general. So I would say if you know, and I always say never issue the debt before you need to, but if you need to issue debt, I think you go ahead and do so now. I don't see interest rates getting lower anytime soon. You know, of course, my crystal ball is as crystal clear on that as anybody else's. But I think where there's opportunity is getting out, having thorough discussions with the rating agencies about long-term financial planning, certainly with respect to pensions and you know, where reserves are, laying that out in a forward-looking way, and then more importantly, in really engaging the investor market and with, you know, whomever a government agency is working with in terms of a financial advisor and investment banker, is making sure that there's go on the offense in talking to investors and continuing that dialogue even after the bond issue.
Okay. Well, thank you very much, Sarah. We have another question that's in with regard to the impact on pensions, but I'm going to hold that because Steve Malikian is going to be talking about some of the pension issues, and we'll pick that up at the next round of questions. So I want to welcome Steve. Thank you very much for joining us. He's bond counsel at Jones Hall, and also at our request has provided sample disclosure guidelines that are in the agenda packet for today. So we thank you for that, Steve, and please carry forward.
Thank you. Don, can you hear me okay?
Yeah, just a little bit louder if you could, Steve.
Okay, no problem. So bankruptcy itself is the big cloud that's over the marketplace, and although it is not directly addressed in disclosure, much of the disclosure that we are including now on general fund offerings really is being driven to answer questions about bankruptcy risk. And so that's why we want to go ahead here and talk about just bankruptcy generally, what's going on in Stockton, in San Bernardino, and in Detroit, and what the ramifications of that might be with regard to California issuers. So let's start with a scenario such as Stockton or San Bernardino where the city's actually in bankruptcy, and the question becomes, what do they do? How do they get out of bankruptcy? And the areas that a bankruptcy court would look at would primarily be the areas listed here on this first slide, potential areas of savings. You have labor contracts that could be rejected by the court and rewritten by a bankruptcy court. Pensions, that's the big question mark no one really knows about. Retiree health care, and I'm sure everyone knows what happened in Stockton where they severely cut retiree health care immediately upon entering bankruptcy, and many retirees just lost all their health care completely. And then there's bond debt service, which is a big question in Stockton and, of course, also in Detroit. And in a way, those are the areas that a bankruptcy judge is going to have to look at, because under California's Constitution, there really is not a lot of other areas where a city can make long-term obligations. So, I mean, there might be some leases the city has for office space that were not financed with COPs or lease revenue bonds, but by and large, those would be the kind of leases where it probably wouldn't make a big difference one way or another whether the city continued to pay the lease or walk away from one of those leases. So with labor contracts, you know, the three approaches to save money is really the first one is the last one here is just to cut employees, which we've seen a lot of California cities, counties, and special districts do the last few years during the Great Recession. Then, of course, they're cutting pay, which would include unpaid furloughs, and also cutting benefits or requiring employees to pay a larger share of their benefits. With regard to pensions, you know, the big question that is going to be addressed in Stockton and in Detroit, and whether it's addressed in a way that ultimately gives guidance to future bankruptcy cases, is how protected are pensions in bankruptcy. And the two arguments against a bankruptcy court or a bankruptcy judge changing pensions are that, and this is really applicable to California and maybe applicable in many other states, is that pensions are contracts that have special statutory protection under state law. In effect, they have the equivalent of a lien or a preference over other contracts. And the California courts have continually upheld the primacy of pensions, which should be honored by a federal bankruptcy judge. Bankruptcy judges, because they're federal judges, quite often don't like being told what they can and cannot do with state contracts. The whole point of bankruptcy is to clean up a mess, and a bankruptcy judge is going to do it in a way that it thinks is most equitable within the constraints of the law. And so a bankruptcy judge could theoretically determine that pensions can be modified. You know, no one really knows, and if you were to ask 100 bankruptcy lawyers who know this area, they probably would answer 50% yes, a judge might be inclined to do it, and 50% they won't touch it. So there's a lot of uncertainty. But if a judge were to rewrite or change a city, county, special district's pension obligation, they would have to do so in a way that they would have to make a determination that a legitimate fiscal emergency or crisis exists, and that the proposed solution is reasonable and necessary to address the fiscal crisis or emergency, and there is not a less intrusive way to accomplish the same result. And that leads back to what happens in a situation like Stockton, where the argument's being made that we've already cut retirement health care, we've cut staff, we've cut wages, and pensions are part of the overall compensation of employees, and we've already done significant cuts for them, so it's bondholders' turn to take some cuts, and so the rest of the pain should fall on bondholders. And so that's going to be very interesting to see what happens in Stockton and what happens in Detroit, and I, personally have no way to predict one way or another how this all turns out. And results also with regard to pensions may vary state to state depending on protections afforded through state constitutions or by statutes. Moving on to retiree health care, California law does not have any similar provisions protecting retiree health care the same way that it protects pensions. And as I mentioned earlier, Stockton has drastically reduced its payments for retiree health care. And in fact, one of the strategies being pursued in Detroit apparently is to pay retirees that are too young for Medicare a fixed stipend and have them covered under the health exchanges being set up under the Affordable Care Act as a way of saving money. And so that's another strategy you might see maybe even out of bankruptcy at some point. So moving on to bond debt service, the area that I actually know most about is that revenue bond debt service with statutory liens are protected in Chapter 9. And that would include water revenue bonds, sewer revenue bonds, your general enterprise revenue financings, airport, electric, and it actually also includes tax increment bonds, interestingly enough. There is a provision in the bankruptcy law that says bankruptcy cannot defeat the lien of tax increment. Interestingly, GO bonds in California, though they have been, there's been a lot written about the Detroit GO bonds and a lot of questions as to what full faith and credit means and all that. California GO bonds are a strange animal in that they are not a full faith and credit obligation of the issuer. I'm not talking about the state bonds. I'm talking about when local governments issue general obligation bonds, because the way they're paid is really through an ad valorem override. And in a way that's like a revenue pledge. And there has not been a lot written about this, and there's only one decision I'm aware of, and I think involved the San Jose Unified School District bankruptcy back in late 80s, early 90s, where the bankruptcy judge continued to allow the GO bonds of the district to be paid on the theory that the only purpose that money could be used for that was collected to pay bond debt service was bond debt service. Under the state constitution, it couldn't be used for anything else. So nobody gets any benefit if you stop paying those GO bonds. It doesn't help other creditors. It doesn't help the governmental entity in bankruptcy. And Moody's recently identified California as one of 5 states that provide for what they call a statutory lien for ad valorem debt. And that's in one of the articles in the back. There's 3 Moody's publications that talk about, I think it's California, Detroit, and then some other general issues that are very interesting reading about Moody's perspective on what's going on right now with government finance. The debt service that is most at risk is what Sarah was talking about, COPs, lease revenue bonds, and really the worst case scenario, or pension obligation bonds. With COPs and lease revenue bonds, there is an asset there. And if a city were to say, stop not making lease payments like Stockton did on its parking garage, you would end up with a situation where the remedies in the lease allow the bond trustee to come in and kick the city out and take the facility and operate it, or hire someone to operate it and try to make some money off of it to pay bondholders. Pension obligation bonds don't have assets. They're just an obligation to pay. And so in bankruptcy, you could see, and Stockton is in a situation, you could see an attempt where they want to basically wipe out, if not all the debt, a very high percentage of the debt, and there's no real remedy for the bondholders to pursue. At least with lease revenue bonds, there is the theoretical right to go in and kick out the city or the county or the special district and release the property and try to make some money so the bondholders get something out of it. And so, and this Stockton is also a good example of asset essentiality, because Stockton walked away from leases where they didn't consider the assets essential, and they are continuing to make payments on some leases they consider essential. So if you are leasing City Hall or fire stations, chances are they're not going to try to renegotiate those leases, or they may try to renegotiate it, but they maybe have a little bit of a different, less leverage than they would if they were leasing, say, a community center in a park. While it may be important to the community, it doesn't have quite the essentiality of a city hall. Now, I'd like to just tie this back to disclosure, and just what we have been seeing with disclosure is, in the old days, people would talk about in a lease revenue bond, they would describe the asset. There'd be the typical description about the bond, risk factors, and then the disclosure on the issuing entity would talk about their sources of revenue, property tax, sales tax, and it would talk about their budget policies and maybe touch on their budget reserves and all that. And I'm going back 30 years or so. And no one really focused at all on pensions. No one focused on unfunded retiree health care. And that is, those two things may be becoming the two biggest issues in disclosure, both from a perspective of what the market wants to see and understand about an issuer when they're in the market, and also in terms of enforcement actions by the Securities and Exchange Commission, where you go to market, you sell your bonds, and 2 years later you get a letter from the SEC saying, you really didn't disclose adequately about your pension obligations, and they've gone after the state of Chicago, state of Illinois. They've gone after the state of New Jersey. There were rumors they were actually investigating California, but I've heard nothing about that for quite a long time. So I suspect that's either they investigated and decided nothing was done poorly, or nothing was done in a way that required the SEC enforcement action. But when you're disclosing about pensions and retiree health care, if you're in CalPERS, there's limited information you get. You do the best you can. If you have your own pension plans, it gets a lot more complicated. Entities like San Jose, Los Angeles, who have their own pension plans, they spend probably more time on that aspect of the financing, updating disclosure, than they do anything else on a financing. And I just want to emphasize that since the official statement is ultimately the responsibility of the issuer, it is really important the issuer take ownership of this. And what we have found in the last couple of years is that there are some issuers that seem to understand that aspect, and they embrace it, and others will say, well, we can only tell you what we get from CalPERS and what's in the audit. And sometimes that's not all the information people want to see, and there may be more information readily available. And the fact that it's not in the audit doesn't mean you shouldn't disclose it. So I'm kind of jumping very quickly here due to time constraints, but if you do have an issue coming up, please focus on retiree health care and pensions, and make sure you have complete disclosure on it.
Okay, well, thank you very much, Steve. And again, if you're tuning in or didn't get the announcement earlier, in the agenda packet for today's session, there are a set of disclosure guidelines. We asked, on behalf of CSMFO, Steve, to provide those draft guidelines so that you could see how some of these issues of concern to the market play out and the types of things that you might be advised to disclose and how you can do that effectively. So let's move on to another polling question here. And so we're going to look at what people's experience is with current debt financing requirements, and going to launch this survey. And while I'm doing that, I'm going to really turn to Steve and also Sarah to respond to one of the questions that came in while people are answering the questions here. And that is, it's a question really with regard to pensions. How long into the future do you foresee municipal pensions having impacts on municipal bond and debt sales? Any suggestions on resolving the pension issues as they affect those sales?
Sarah, do you want to take that, or you want me to take it?
Well, I think it's going to change. I think it will be different for different different government agencies. For some government agencies that are smaller entities, you know, particularly cities that are fairly recently, like in the last 10 or 20 years incorporated, the nut to crack is not quite as large, and therefore the discussion isn't as problematic even today. But I think others will have a longer path to it not being a real disclosure item. I mean, it's always, I think it will be something that until there's comfort that the issues are manageable given the revenue streams and given the reserves, I think it's going to be discussed. I think there's another problem in that the media has also blown it up as discussing as if all government agencies have this outrageous unfunded pension liability, and so there's somewhat of a need to get the word out publicly. And I would imagine that, you know, you as issuers sort of face that question periodically, and probably at every time the budget is discussed or a employment contract is being renewed with one of the unions. Those issues come up in your council meetings and with various gadflies, and you probably note the misunderstanding. Well, I mean, that permeates throughout the country, and you know, each time, you know, there's not too many articles about the government agency that has maintained a balanced budget and been fiscally responsible for, you know, through this recession. No, the articles are about the opposite of that, and so some of it is just public perception of what's really going on at the local agency level.
Okay. Well, thank you very much. And again, if you have additional questions, we encourage you to send them in via the question function on the webinar. We'll be covering those later. We have two more presenters, one from a creditor's point of view. What do investors look at when they're doing these bonds? And then we're going to be going to that next. And then what's the agency perspective on how to fulfill all these disclosure and compliance requirements? So you can see the results of the poll there, and I'm going to move forward from it. turning to Jennifer Johnston, Vice President and Research Analyst for Franklin Templeton Funds. And we're very delighted to have you, Jennifer, and appreciate you providing a perspective about how you look at the issues concerning investing in bonds like this and how that impacts their attractiveness in the market.
Great. Thanks, Don. I'm glad to be here. And we always like the opportunity to talk to issuers. It actually doesn't happen often enough in our mind. We actually really enjoy the dialogue, and you'll hear me say it a few times during my presentation, but we encourage issuers to reach out to us, even if it's not disclosure related, not around finances or anything like that. We're happy to look at investor websites and that sort of thing. So just know that your creditors really do like to have those conversations with you. But what I thought I would do today is really kind of let you sit at my desk and get a little bit of a perspective on how I do my job. And I think both Sarah and Steve have given you a really good overview of the market and sort of one of the big challenges we're dealing with. And I thought sort of really getting into the nitty-gritty on how I do things might help illuminate why we ask the questions that we do and seem to be so darn demanding these days. What I'm going to really focus on is the bond security, the issuer credit, and disclosure. I think Sarah did a great job on talking about the market, so I'm going to just kind of quickly touch on that. But when we sit down to look at a new deal or even to do surveillance, the first thing we want to do is understand the security. Is it a GO bond? Is it some type of dedicated tax? Is it a lease revenue bond or a COP? Each type of security kind of brings to us a different set of requirements or credit features or a credit profile that we would like to see. So the first thing is to understand that. Is there a mortgage lien, leasehold interest? Is it a full faith and credit pledge? And really, as Steve pointed out, in light of what's gone on with Stockton and San Bernardino and now in Detroit, I really think this question is even more important. And part of my job is to understand the nuances between how an issuer, what a security is for an issuer in California versus all the other states. Because as Steve said, GO bonds are different in California than they are elsewhere. Next up, we want to look at sort of what's the overall issuer credit quality. And I'm going to spend most of my time focused on number one, and I think that you're going to appreciate a lot of what I say here. The first thing we need to determine is really understand kind of what's the framework that an issuer exists within. What are the legal constraints? As I said earlier, a GO bond in Alabama is very different than a GO bond in California. It's important to understand how difficult it might be to raise taxes. We want to know if there are any tax caps that a local government could be subjected to. We want to understand a relationship between a local entity and the state. Is it a state that always sort of unloads their financial problems on the locals? Or is it a state that actually provides several forms of oversight or loan programs or that sort of thing if a local government encounters financial difficulty? We want to understand the rules or processes surrounding bankruptcy, again, heightened more recently. And if you take all of those things and apply them to California, you'll understand that here GO bonds have very strong structures. Again, as Steve outlined, sort of the way it works in California, it does appear to have a statutory lien. However, we also understand it's hard to issue GO bonds. Why is it hard? Because they have to be voter approved. And in our experience, it's the easiest to do that if you're a large city, a school district, or the state. For most local governments, that's hard to get done. So what happens then? Well, local governments move to the lease revenue structure or the COP structure. So it's important as a bond buyer to understand that that's a limitation that local governments sort of have to fall under as opposed to just being able to issue GO bonds, which may be more common in other types of local governments or more common in other states. It's important to know how leases are different here in California as opposed to outside of California, and abatement is a feature that's different. It's also important to know that it is very hard to raise taxes in the state of California. Both politically as well as legally, it's very difficult. And of course, we also have Prop 13, which also creates a cap on a lot of entities. And in terms of the relationship with the state, I think we all understand the relationship with the state. And unless you're a school district, there's generally not any strong sort of fiscal oversight or support when municipalities run into financial problems. So the next thing we'll want to do is take a look at the financial position. For a local government, where does its revenues come from? Where does it spend its money? Has it generally had surpluses? What kind of fund balances does it have? What's liquidity look like? And coming out of recession, we can really take a look at how that local government dealt with what was likely a period of declining revenue. Were they aggressive in managing costs? Do they tend to just rely on high fund balance to draw down to cover expenses? Did they utilize deficit financing? What were the tools that they utilized during the recession? And again, this brings back into play both sort of their legal the tools that are available legally to them as well as politically. And then if I own a lease revenue bond or a COP, as I think Steve talked about when it comes down to the security, I'm fighting for my payment along with just other operating expenses of the municipality. So I really want to understand what else I'm competing with for my debt service dollars every year. In terms of debt and pension, I mean, really what this comes down to is understanding what the long-term fixed costs are for a local government. Generally, debt and pensions is a number that doesn't go down. It can only go up, it appears. Of course, you can refinance debt, but generally people have continuing capital needs and will continue to add debt on. And then with pensions, as it appears right today, pensions can't be cut. They can only be increased. So with also adding into that CalPERS changes, that seems to be an increasing dollar for most municipalities these days. So we need to understand what those fixed costs are and understand what they're going to look like over the long term. It's not just next year's debt service payment that I'm worried about. I think I'm entering into a 30-year partnership with a local government when I buy debt, and I'm concerned about what that's going to look like going forward. We also spend a lot of time talking about what percentage of general fund spending is allocated to debt and pensions, and also healthcare costs I would include in that as well. These generally are fixed costs, and if another recession happens, which I know it will eventually, what are sort of that portion of the expenditure budget that a local government's going to have more flexibility over when dealing with distress. We also want to understand demographics, the local economy, and wealth levels. We'll usually focus on whatever the dedicated revenue source is and use that as our jumping off point for looking at credit. If you are heavily reliant on sales taxes, we're going to want to understand your wealth levels, the strength of your economy, and what your retail sales tax base looks like. If you're largely reliant on property taxes, again, we want to understand the tax base, understand your housing market, and get a sense for whether your housing stock is mature. Again, Prop 13 would play into that. And finally, we expect to have a discussion with management, especially in the primary market, but also it's often our only source of information on a surveillance basis. Again, we think we're entering into a 30-year partnership, and we want to have an ongoing relationship with our issuers. And I think this is really important because so much is not stated in financial statements, and understanding how a local government makes decisions is important to us so that we can anticipate what things will look like down the road next time there's some type of trouble. Additionally, and I'll talk about this in a second, sometimes if we can't find updated information from a disclosure standpoint, the only way we get updated information is from our discussions with management. So we take that pretty seriously. So the next issue is disclosure, which is my favorite subject. I sort of believe that the ability to issue debt in the tax-exempt market really is a privilege and one that's up for debate right now. But with this privilege sort of comes responsibility. And obviously, in addition to just repaying your debt, we really believe that the responsibility is providing disclosure, and that is your ticket into the tax-exempt market. Disclosure absolutely matters, and it matters even down to our decisions as to whether we're going to buy, sell, or hold. You wouldn't buy a house without getting an inspection, without seeing it, without looking around in the neighborhood, checking out local schools. We feel the same way when it comes to buying bonds. We're not going to buy a bond without doing our homework. And I'm not going to be able to buy a bond unless I have information that's timely as well. And it's not just information available at the time of purchase. It's information over the life of the bond, or as long as we own it. We produce surveillance on everything that we own. We price our bonds every day, and we need to know at any time what the status is in any of our holdings. If I have 5 deals on my desk at any one time in the primary market, all other things being equal, the deal I will look at first is the one that has the best disclosure, because that's going to make my job the easiest and enable me to give the best information to my portfolio manager when assessing what the interest rate should be on these bonds. And if I only have time to get through 4 deals because that 5th deal had terrible disclosure, that's one less bid or one less buyer that could possibly be involved in your deal, or providing liquidity in the secondary market. And so it can affect you. And so and I'm pretty sure I speak for most analysts, that if we do not have information, we can't look at your bonds. So it really, really is crucial. Also, when I look at issues in the primary market where disclosure is usually excellent, it's really improved substantially over the last 10 to 15 years. We do actually check to see how an issuer has been doing with continuing disclosure. Even though we may never have owned an issuer's debt, if they have other debt outstanding, we'll go back and check to see whether or not they have disclosed on time as per prior continuing disclosure agreements, and whether they've provided additional information, are their budgets available on the website, and that sort of thing. So we do actually look into past compliance with CDAs when making primary market decisions. We've also seen a lot of action regarding lack of disclosure. There's actually ratings being withdrawn on credits that don't disclose. In fact, just last week, or perhaps it was the week before, S&P withdrew a number of ratings in Alabama because they did not have timely disclosure. So it's not just folks like me who are asking for this. Rating agencies also can't do their jobs without it as well. And if you lose a rating, it again will affect your liquidity in the market. If I want to trade a bond and there's not adequate disclosure, I may not be able to. I might not be able to find a buyer for my bond if there is not good disclosure in the market. So it actually affects us both in terms of our buying decisions as well as if we decided we wanted to sell a bond. Next, I want to talk about timeliness, because I feel like I have to talk about timeliness. I understand that getting an audit done on a timely basis is difficult. I wouldn't want to have to do that myself. I'm sure it's extremely time-consuming and difficult to do. So we get that. We would prefer to see it sooner than 9 months, but we understand that that's sometimes a problem. If I want to do disclosure today or surveillance today on a credit, and I go to look for updated financial information, the most updated information I'm probably going to be able to find is from June 30th, 2012. That's now 14 months old, and that is too old. And not only that, but it was probably only made available in January or February for most issuers. That information is not only old, but it really serves you as an issuer a disservice, especially coming out of a recession, when every year your financials probably look stronger and better, and you're seeing revenues come back. You're probably seeing expenditures slow down a little bit, their growth slow down, as you've seen ongoing budget cuts you've made over the last few years really stabilize. The thing is, I'm not going to know that, because the most recent financial information I'll have access to is 14 months old. So I certainly don't expect there to be an additional audit done any more quickly, but we really do need additional information, whether it's a copy of the report you provide to your city council on a monthly or quarterly basis, even if it's just the budget. Budgets are sometimes hard to, depending on the format that they're in, or don't quite always meet our needs, but oftentimes there will be information where we can understand the priorities in the local economy and that sort of thing that a local government is facing. But really, especially right now, a local government is really not helping themselves without having timely information out there, and just letting the market know sort of that you're doing better and kind of how things look. And I'll recommend NASAC, which is the National Association of State Auditors, Controllers, and Treasurers, just last week published some recommended best practices on interim disclosure, and I realize that's aimed at states, but it's really a well thought out approach to explaining why interim disclosure is important and giving some recommendations on what states can do. And I highly recommend that if this is something you're interested in, that you take a look at that. And I'll also recommend any of the best practice documents done by the National Federation of Municipal Analysts, the NFMA, which I'm a board member on, just the topic of disclosure. We also put out periodic updates on recommended best practices, and we're currently finalizing one on general obligation and general fund obligated debt. Again, these are great ways for you to get a sense for what we're interested in. And then thirdly, as I said earlier, call one of us. You know, work through your financial advisor or somebody and just reach out to some investors and try to get a sense for what they need, because as what I'm about to get into when we talk about how much things have changed, you know, I really feel like it's sort of this partnership again that we kind of enter into that's going to help us hobble along until we figure it all out. So I would recommend that you do that. In terms of the market, I'm not going to say much here. Sarah did such a good job, but just understanding that when we make buy or sell decisions, it's not solely credit that drives us. It can be supply, how many other bonds are being issued, you know, same day yours are, what are our cash flows like in and out of our funds, what are rates like, spreads, what's the impact of retail. Retail is a huge component of our market. And then finally, we do daily price the funds, and so we are obviously always interested at all times on your bonds, and also your bonds can trade in the secondary at any time, and you probably don't even know it. So another reason for good disclosure. And again, in terms of buy, selling, and holding, if we don't like a credit or a credit turns negative, we don't necessarily sell it. There still could be compelling reasons to own it. We don't necessarily buy every credit that I love because it might not be priced appropriately. And on the flip side, sometimes we buy credits that you know, I could be negative on, but that's because we're being paid for the risk. So there's lots of little kind of interesting intricacies over that question. So some of these things you can control, like disclosure, and some of these things like market conditions, you can't, obviously, but you can definitely help make the process easier and improve liquidity by providing good disclosure. So next slide, Don. So in terms of how things have changed, a lot of these things we sort of touched on, but first I want to talk about bond insurance. So bond insurance has essentially dried up for a couple of reasons. We have some bond insurers who are no longer writing policies, and we also have bond insurers that have been downgraded to a point where perhaps an issuer's underlying credit quality is actually better than that of the insurer. Needless to say, whichever it falls under, there is now a larger focus on the underlying credit of an issuer and not to other entities like insurers. And because there's less insurance, you're more likely to get calls from people like me. Before, people just looked towards the insurance company for the credit. Now we're actually looking towards you. And that could be even if you still have insurance on your bonds. If you're more highly rated than your insurer, then you're now the person we're going to be looking to. So if you haven't already seen it, I would expect that you're going to see an uptick in people like me calling you. And you know, I always kind of get a kick out of it when I hear an issuer say, wow, I've never heard from somebody like you before. So this is sort of what we're seeing in the new world. Ratings have been a really interesting thing to watch over the last several years, and I imagine that you're probably a little frustrated with it as well. In the middle of the recession and financial crisis, we had recalibration by 2 of the 3 agencies. While not confusing to people like me, I mean, honestly, my job is to sort of outguess the rating agency. It's confusing to retail. You know, then once we recalibrated, we had a lot of downgrades because of credit declines, and so you know, it's definitely been sort of an odd universe for ratings, and you know, some people now will drop a rating agency, and it's all very confusing. So just know that that's sort of added to what we're trying to grapple with when bonds come to market. And a bit of advice: if you were recalibrated to a higher rating, that is not an upgrade. So I have spent a lot of time explaining that to people, which I find interesting. Third, bankruptcy. So clearly we've had 3 major California local governments declare bankruptcy recently, 2 of which are ongoing. And as has already been discussed, there's just a lot that we don't know. What we do know is that it's scary and expensive, regardless of what side of the battle you're on. And I think with the bankruptcy in Detroit, it sort of added a whole new level into what Sarah said. It's something that now a lot more people are focused on. I mean, I feel like most Californians probably knew that we've had a couple bankruptcies, but now the whole country knows that there's this issue with municipal bankruptcy out there. And in California, we operate in this environment where local governments are forced to issue these lease revenue bonds and COPs, which, as have previously been discussed, aren't as strong as GOs. And as a bondholder who buys these bonds, knowing full well that that's the situation, we've spent decades believing that municipalities would continue to honor those arrangements, and we certainly expect that most will. But the fact that this has now happened has been very scary to us. And then, one of the things that we're very, very open about is that we are currently not buying any local government leases in the state of California. We will buy school districts and we'll buy the state, but no local governments. And there are a whole host of reasons. One of them is we think that there's still an inaccurate rating of these bonds by the agencies. And as Sarah pointed out, that seems to be changing, but we're still not quite sure that we think that they're rated where they should be. So if they're not rated correctly, they may not also be priced correctly. So we're staying away from them for that reason. And quite frankly, there's just too much uncertainty. We never really expected governments wouldn't appropriate. And until these cases sort of make their way through the process, we're just not willing to get involved. Our shareholders are too important to us to do anything like that. And quite frankly, and I think Steve had said something about this earlier, what we're afraid of is that cuts that come either as part of a debt restructuring or part of cram down, those are permanent cuts to bondholders and the shareholders. But cuts to services, employees, salaries, and pensions are temporary. And that's really scary to know that you're the one who could suffer a permanent cut, and local governments or pensions or services or salaries or whatever could be increased down the road through just general budgeting and agreements that way. So while we do know that Stockton and San Bernardino exceptions, we're definitely sitting on the sidelines right now, and we are one of the largest buyers of California debt. So we will not be, probably not bidding on your bonds if you come to market anytime soon. So for media and headline risk, again, I think we kind of feel the same about this. We don't like it. Again, Sarah commented on this as well. And, I think it's an issue in that we have to respond to it. So if you're going to be in the news or the headlines, A, we're going to hear it, and B, I'm going to call you. So just a heads up on that. And then, disclosure really is now as important as ever. And the more that you can help, the better you're going to make your ability to issue debt. In conclusion, I thought I'd sort of summarize by looking at it differently, and that's by highlighting kind of the challenges. And I want you to know that we do understand that they exist. The first is decision-making in a political environment. I'm well aware that it's much easier for my boss to cut my salary, make me contribute more to my health care, or lay me off than it is for a local government. I totally get that. At the same time, though, it's these tough times where these politics seem to be even more apparent, and we need to understand that. Pensions, OPEB, debt, these long-term liabilities, it shouldn't be a versus thing. Everybody should have a vested interest in that a city thrives. In terms of bankruptcy, this is terrible for the market. We do not like uncertainty in the muni bond market, and we don't like the potential that we could have our debt permanently cut while other creditors have short-term cuts made, or in some cases no cuts. Bond security is more important than ever now, and that's being highlighted by the recent bankruptcies. We know appropriation risk is inherent in leases, but we also believe that this reward for issuing debt in the tax-exempt market is the repayment of that. We try to get through headline and media risk just like you guys do, and really in our little market sector here, it's really changed significantly over the past 5 years, and we have to change with it. And like I said earlier, issuing is a privilege. granted to those who repay their debt and provide disclosure. And I'm hoping that if we continue to create these good partnerships, we'll have success and all these things will happen. And we're on the same side. We want a city to generate revenue, have low crime rates, have well-manicured parks, have libraries with long open hours, and appropriately pay their employees. But at the same time, we're going to fight for the rights of our shareholders because, quite frankly, our shareholders could be you. And anybody like you or your parents or whomever, we really want to make sure that they get their money back too. So I'll leave it at that.
Great. Thanks so much, Jennifer. And really striking in terms of Jennifer's interest in actually developing the partnerships and relationships with local agencies, which seems to be very refreshing. And so that leads to a polling question of what are you doing in your agency to help strengthen investor understanding of your agency and its debt. So take a moment to respond to that. And while doing that, we've got a question that came in, and this actually might be something more for Steve or for Sarah, but does it make sense to put the CalPERS pension liability shortfall into a separate fund? Will that improve chances of issuing bonds?
If the question assumes that the city has reserves and they actually do have the ability to fund that deficit, I'm not an actuary, but yes, in effect, setting aside money and legally restricting it is probably not a bad idea, or just, I don't know how it works with CalPERS, but I assume you can send more money in than they bill you for in a year. And any way you can to show a reduction in that deficit is going to improve the marketability of your bonds.
Okay. And here's a quick one for you, Jennifer. Is Franklin investing in enterprise revenue bonds?
Yes, absolutely.
Okay.
Yeah, absolutely. And the reason why is to what Steve mentioned, that we believe that those are a statutory lien on those revenues.
Okay. So here is the response to the question with regard to reaching out, and it looks like there's some additional opportunities that are identified there. And thank you, Jennifer, for opening the door to CSMFO members to develop a stronger relationship with you and maybe bring you back into this market. Okay, so we want to be sure to give time here to Lisa Tetano, who's the debt administrator at the City of San Jose, about how does an agency finance professional deal with all this, all these requests, all these requirements. And Lisa, could you please help guide your colleagues in what you do and how you do it?
Yes, thank you, Don. Yeah, I'll focus on in-house, our efforts to improve primarily disclosure. To give you some background, the City of San Jose and its related entities have debt outstanding totaling over $5.2 billion, and that's comprised of 129 series of bonds, 2 commercial paper programs, and 7 loans. To assist in running such a comprehensive program, the city has developed a debt management policy, a policy for the issuance of multifamily housing revenue bonds, and is currently embarking on development of a disclosure policy. And I'll talk more about that later. Could you move to the next slide, Don? Thank you. Development of an official statement. San Jose's official statement has evolved over the years and has become a huge undertaking. For example, our 2013 lease revenue bonds, the city used 50 pages of the OS to describe the transaction, but more than 300 pages were used to describe the city's general overview, its pension disclosure, and financial statements and other attachments to the OS. In the city's Appendix A, contains the city's general information, takes about 79 pages. But what's really grown and developed separately to cover our pension and OPEB was our Appendix B. And to make sure that we capture all of the critical information so that investors know the condition of not just the city, but primarily our pension and OPEB costs. We engage staff from the budget office, from the retirement department, our public works, the city attorney's office with bond counsel, of course, and then the one that I've added on the slide for this presentation was Office of Employee Relations, and they handle all of our contract negotiations. They've been an integral player in our disclosure in that our negotiations, it kind of guides where our, not just our labor costs are going, but also our pension costs, which are part of the negotiations. The city invests a substantial amount of resources to make sure the information in SOS is accurate and timely. The contributors to the OS not only work collaboratively and for long periods of time, but they also meet frequently so that the information is constantly updated, particularly right before we go to market. You could go to the next slide, Don. Thanks. So I talked about how our disclosure has grown just in sheer number of pages, and actually we've increased from 2 to 40 pages. That's actually 50 pages now with our last official statement. It just changed in 5 minutes. To do our pension disclosure, we have an extensive review by all of the contributors to the disclosure, our plan actuary, retirement staff, city attorney's office, and disclosure council. Pension disclosure is very complex, particularly if you manage your own retirement plan or plans. The city has 2 plans. One is for our general employees, and the other is for public safety. And we literally have to describe 2 completely different liabilities and obligations because of the way that their contracts are structured. We use consultants and legal counsel. A paper that I am going to strongly rely upon in further developing our pension disclosure was issued by the National Association of Bond Lawyers, and the paper was published in May of 2012. It has a long title. It's called Considerations in Preparing Disclosure in Official Statements Regarding an Issuer's Pension Funding Obligations. And the paper refers to itself as Considerations. That's what I'll call it. It's a concise but informative paper that can be used to develop pension disclosure checklists, educational material, and disclosure policies. It addresses particular issues that arise when putting together pension disclosure, and it provides key definitions, key questions that should be answered when preparing your disclosure, and it has an excellent overview of related GASB proposals to help you work through some of those complex issues. The paper can be accessed without a membership to NABL. If you go on their website and you just go into their search screen and put in considerations, the paper will come up at the top of your search. You can move. Next slide, please, Don. Secondary market disclosure. Our annual report is pursuant to requirements of our continuing disclosure agreement. We include our continuing disclosure agreement as our Appendix G in our primary disclosure documents, and it includes a form of our continuing disclosure agreement and the timing at which it's released and all of its contents. We also pay a lot of attention to rating agency periodic reviews. The city is very diligent in maintaining open communication with the rating agencies. It's very challenging to keep up with the frequency of their surveillance reviews, particularly when our rating is on a negative outlook and they change the frequency from annual to quarterly. But we always, when the rating agencies call, we drop what we're doing and we make them a priority. We too are concerned about the change or the inconsistencies in the way that rating agencies are rating not just amongst themselves, but for the different securities and types of financings. So we want to make sure that they have as much information as possible in order for them to complete thorough reviews of our credit. The CAFR and our CAFR and our budget reports are always included as part of our disclosure. And we do issue material event notices. I think that we are caught up with every event that we need to report, and we'll post everything onto Emma as well. SEC Rule 15C212 has become a greater threat in the recent years than in the past. SEC Chair, recently hired Mary Jo White, was appointed in early 2013, and since her appointment, the SEC has pursued more enforcement actions in the municipal securities market in the first half of 2013 than it pursued for the first half of 2012. And that same trend carried from 2011 to 2012 as well. This is concerning as recent SEC enforcement actions are aimed at local governments, their officers, and public officials. And it emphasizes the need to raise awareness of federal SEC laws with city officials and staff that speak to the public. There have been several actions where the inaccurate information that prompts the investigation was made verbally, not in writing, nor was it intended for investors. What we're finding that is if a statement is made publicly, whether verbally or in writing, and there is a possibility that an investor could access that information and use the information to make investment decisions, the content of that statement must adhere to federal SEC laws. That's a much more rigid interpretation than in the past. That is actually why using an investor website is strongly recommended. It makes clear your intent where you are placing information intended for investors as opposed to just general information that you're publishing for the general public. So what we recommend is that you have an investor website, and then in your general areas, make sure that you have notices directing investors to your investor webpage. So at least you're diligent in getting investors to be looking at the same information. Although they are always open to looking at any information published on your webpage. So want to make sure you're aware of that. Publicly available reports and periodic education to the City Council. We do our quarterly investment and debt reports, of course our comprehensive annual financial report, but we also do a comprehensive annual debt report that you can find published on our website. We do monthly financial reports that are not quite as extensive. And we also prepare comprehensive staff reports that highlight key disclosure issues, and we perform City Council study sessions. Reporting to your approving body is important. Unfortunately, it often doesn't allow for dialogue. When our council requests for a study session or pulls a potential disclosure issue off of a consent calendar to discuss, we always try to be prepared. Any opportunity to have dialogue with our city officials and keep them updated with current financial information on the organization, we always capitalize on that opportunity. Jennifer was talking about timely financial information. The city presents its CAFR within 5 months at the end of the fiscal year. This rigid timeline helps us to keep our financial data current and meaningful. One way that the city is trying to tie these reporting requirements into a nice little bow is working on developing a disclosure policy. One of the handouts that came with the presentation is a draft disclosure policy and procedures. City of San Jose is going to start with that draft and develop a policy in hopes that the city will embrace it and adopt the policy and help guide our disclosure and keep it as a high priority for the city, city staff and city officials.
And while Lisa's concluding her remarks, I'm going to put a polling question up so that people have an opportunity to respond to that while you're speaking, Lisa, so excuse that interruption, but please go ahead with your closing comments because people will want to hear the important points that you're offering.
Okay, thank you. The key points that we always try to remember is disclosure is the city's responsibility, and we cannot rely primarily on consultants. City staff, city officials must remain active and involved in the process. Disclosure is difficult and requires constant diligence, and that's why we invest the necessary time and resources to do it thoroughly. And it is critical to the city's reputation in the capital markets, and I think all three speakers before me really did emphasize that.
Okay, well, thank you very much. And what we're seeing, and we're going to give a moment or two more because more people are voting here, is some comments from folks about that. And again, we're getting some questions about downloading the slides. They're available at csmfo.org/training/webinars, and you click on live audio and archives, and the information is there. You'll also be getting an email from us within a day that will give you the location for that information, so you don't have to remember that website. It'll be available to you through an email that you'll receive. At least the person who registered for the session will be the one receiving that. Okay, let's take a quick look at this poll. One of the key things that Lisa was highlighting to you is the importance of working together as a team. So here are the results that came forward about that. Looks like there's some opportunities to include some additional players that are called upon to handle some of the disclosure requirements based upon the changing market conditions that you've been hearing about in today's discussion. And we have one final poll that I want to go to for you here, and then we'll be coming back to you for a quick 30-second kind of closing comment from our speakers. But how was this session of value to you? And while this is being launched and people are responding, if I could ask Sarah, Steve, Jennifer, and Lisa to just give a quick sentence or two of what you'd like people to take away from today's session. Sarah.
Well, thanks, Don. I really, again, appreciate everybody's participation in this. I think that I certainly don't want to leave anybody with the impression that local government agencies cannot efficiently issue COPs and lease revenue bonds. I just think that there's it's no longer a slam dunk, and some real solid thought needs to be put in the team that's being hired to assist the issuer, as well as the story that is being told to the credit markets, and that includes the rating agencies, bond insurers to the extent that they're a participant, and ultimately to investors.
Thank you very much, Sarah Brown from Stifel. We appreciate your contributions to today's discussion. Steve, quick closing comment from you. What would you like folks to be sure to take away?
Well, I think that Lisa, to some extent, stole my thunder in that the official statement and continuing disclosure is the primary obligation of the issuer. Even if you hire consultants to help you, if there's something wrong with it, the SEC doesn't really care. The issuer has an absolute obligation to make sure it's correct. And yes, you can always make your consultants' lives miserable if you're unhappy with their work and decide to sue them. It's not going to help you with the SEC, and ultimately it's not going to help you with the marketplace. So it's really important that people do take ownership of disclosure.
Okay, great. And Jennifer, thanks for sharing your perspective about the investor community. A quick closing thought you'd like to offer.
Yeah, just that everything is just in such flux right now that it's a challenge for everybody who's involved on all sides, and just the better communication that I think everybody tries to have is what's going to be the key to getting through this and trying to figure out kind of what the new normal is going to be.
Okay, and Lisa, we got a question in that maybe you could answer while you're giving your closing thoughts, and that is somebody was interested in just having you give an example of what is a type of disclosure issue that you report to council? What would be an illustration of that?
An illustration of something that we would report to council is, a good example is explaining how the pension liability is calculated and helping them to understand how those numbers are derived, and that, yes, much of it is based on assumption, but it's really a basic formula, and that's all part of one of the things that the city emphasizes is to help raise awareness of how costs, the source of the cost and why it's escalating, and how we can come up with creative strategies to kind of alter that formula so that we can contain costs. And to do that, to raise awareness both with our city officials and with our the capital markets, you have to invest the time and the resources in your disclosure and understand all the issues that impact it at a very detailed level.
Okay. Well, thank you so much for sharing that important perspective. I know today we had 4 presenters. Typically we only have 3. We were packing in a lot, but felt that each of these presenters had something very important to share with you and hope that you benefited from that. So thank you so much, presenters, for that work and for all your extra preparation and providing additional tools and information that we are providing in the agenda packet. So you'll see that there are many areas of value that people derive from today's session. We're delighted that you got so much benefit from it and in so many different ways. And we want to encourage you to have some further discussion in your organization about these topics. So we've provided some post-webinar discussion questions. That's also in the agenda packet. And we wanted to highlight for you some upcoming webinars. The California Municipal Fiscal Health Diagnostic, a great piece of work that Michael Coleman has spearheaded. He's going to be sharing this on September 4th in advance of when he's going to be presenting it at the League of California Cities annual conference. It's a good chance for finance professionals to get out ahead and learn about what your public officials are probably going to come home and start asking you about. And then we have economic development on September 11th. So thanks so much, everyone, for being with us today. On behalf of CSMFO, really appreciate your participation. Appreciate our presenters today and our audience for your questions, for your interest, and wish you all the very best in this exciting profession of local government finance. Thanks, and have a great day.